Making money in trading is easy. Making money with price action is easy, but not understanding when not to try to make money is where people lose money and blame the strategies. Even your neighbor who bought Bitcoin when it was at the top knows that to make money more consistently in trading, or in other words, to have a higher probability of winning, you have to trade in the direction where the price is already heading, the trend. But if your strategy is a trend trading strategy, the last thing you want is to risk your money when the market is ranging. It sounds simple, but people lose money first, and then realize that the market was not worth trading. Here's how you identify the range market. In the previous chapters, we saw that if the price is trending, it looks something like this. If it is uptrending, it will make higher swing highs and higher swing lows. If your trend trading strategy gives entry signals near the end of the pullbacks, you will take trades somewhere around here. If the price was making higher swing highs at the time of entering the trade, the entry is completely valid. But if the price does not make a new swing high, it is an early sign of a slow or a sideways market. At this point, the price can make higher swing lows while creating relatively similar swing highs. If this happens, you will probably end with a chart pattern that we saw in the previous chapters. On the other hand, the price can reverse from the previous swing high and find support again at the previous swing low. This is when the range market is pretty much confirmed, and the uptrend is most likely over. In an uptrend, the best time to stop taking new long trades is when the price doesn't cross above the previous swing high, and in the downtrend, the best time to stop taking new short trades is when the price doesn't cross below the previous swing low. But there are different kinds of range markets. One is a wide range that is usually visible on multiple timeframes, and another one is a small range that is only visible on your entry timeframe, as we saw in the previous live trading video. If more people can clearly see a slow or a range market, more people will take trades while keeping the range in mind. If only you can see it on your smaller time frame, and on the higher time frame the price is in a strong uptrend, the price has a higher probability of breaking the resistance of that weak range. But when you see the price could not cross above the previous swing high in an uptrend, it is a good idea to stop taking new long trades, especially with profit targets above the previous swing high. Similarly, if you see the price could not cross below the previous swing low in a downtrend, it is a good idea to stop taking new short trades, especially with profit targets below the previous swing low. But that's not all.